What's going on? Today is the 31st of January 2024. It's Wednesday, and I just wanted to give a little update here. I've done a couple things not on video, very small things. The main thing was SPY. I had an iron condor on, and I finally closed that thing out for, who knows, it was a loser, and I'm probably never doing an iron condor ever again. I guess never say never, but it's going to have to be very specific. I'm not just going to randomly put them on like Tasty Trade basically says you can. So I closed out that SPY Iron Condor, and now I'm just left with two free hedges here. This one gained $1, and this one has gained $4 today. What else? I accidentally closed off. I used to have an MES H4 or something like that on, and it was just a hedge, and I accidentally closed that out. I thought it was just looking at something, like looking at fees or something, and then I accidentally clicked it through, and boom, it filled. So anyways, that was just a hedge. It was a free hedge, so small position. I think the max gain on that I could have made is like $50 or something. But anyways, I guess in theory I saved myself like $5 instead of letting it expire completely worthless. That's that. And then probably the most noteworthy thing is I've never liked how the hedges are with the, let's start with the 112 or the 1122. The hedges to me just seem like they're too far away, right? Like in this one, this is a free hedge, and this is way out here at the 10 delta, and that's after today, which the market has dropped. It's down 1%. It's been down all day. And then right here at 2 o'clock Eastern, which is like basically right now it's 14:11, so 2:11. And the Fed announced the non-rate cut, which people knew they weren't going to cut now. But I think people have gotten way ahead of themselves thinking there's multiple rate cuts coming this year. And I just saw a quick little blip of it, and it seems like they're hinting towards that might not happen. Which makes sense to me. Their target goal is inflation of 2%. And right now it's only like, it's like 3 or 4%. So they're not there yet. And usually, or I don't know if usually, but a good reason to cut rates is when something's wrong with the market. And obviously, well, something's wrong with the economy. And right now, if you're using the stock market as the market, which doesn't usually equal out, but anyways, stock market's all-time highs, employment rates low, interest rates are moderate, but as a consumer, that's actually good for your savings account. I guess it's bad if you're buying a mortgage or credit card debt or car debt and stuff like that. But I'm getting like 4 to 5% on my savings account now, whereas when the interest rates are low, you get like 0.5%. So anyways, all that to say, like, there's no reason to cut rates. Like, there's no logical reason to cut rates. I have no idea why people at the beginning of the year thought there'd be 5, 6, 7 rate cuts in 2024. There's absolutely nothing wrong. Basically, all the indicators are good. The main thing that they are looking at is inflation, and it's still a little bit too high. So they're not gonna cut too soon and then allow inflation to come back up. Makes no sense to me why people thought there'd be rates coming, but I'll be surprised if we get a rate cut in March. I'll be surprised if we get rate cuts at all if the data just stays the same as it is. I mean, until inflation gets down to 2%, I don't see any rate cuts. So, and then even then, they might just pause it. Like, anyways, all right. So with that being said, I've always felt the hedges here are too far out of the money. Like this one's not too bad. It's at the 10 delta, which is still, it's only a 10% chance of profit. That's a 1.5 standard deviation approximately. And then this one on SPY, this one's actually a lot closer. I'm surprised. That's at a 20 delta after today, with the market being down 1%. But I guess my point is these, like, look at like I was just showing you, like, this hedge gained $2, $3 today, right? And this one is flat or maybe $1. you know, which still leaves it negative $25, negative $23. You know, this hedge here, nope, this is the one I'm going to talk about. Any other free hedges? I guess this hedge here gained $8. Oh, this is like the Black Swan hedge or Sweet Bobby hedge kind of theory. And this is really far out of the money. Let's see, that's 107 days. Yeah, it's these two right here. So that short put is at the 7 delta, and then the long puts are at the 4. You know, that's over 2 standard deviations away. And that just seems so unlikely that that will ever make you money. I mean, I know it happens. Supposedly, two standard deviations is like a 5% chance, I think. But again, so in theory, that would be like twice a year, 3 times a year or something that in theory could happen. That's just so far out there, and it's like you're just, I don't know. It's just a lot to manage, especially recently because I feel like the market has been just going crazy. I mean, we're up, what, 20% since this low here in late October. This run here until today, you know, that is 20.23 from bottom to top. And then we just dropped down, you know, right here. We're at basically 19% positive for the last 96 days. So 3 months. I mean, that's just a heck of a run. So I'm just talking about like on 5% pullbacks, I actually want to make a little bit of money, right? Instead of where those other hedges that I have now, I mean, they're like 10, 15, probably 20% out of the money. I mean, this is at the 3,900. So that's 1,100 points. I mean, what's some real quick and dirty math? 1,100 points divided by 5,000. Yeah, that's like a 22% move. I mean, when is that going to happen? Like, almost never. All that to say, I want a hedge that's actually going to pay on like a normal kind of pullback of like 5%, right? So just yesterday, which I'll admit is totally lucky, I put on this hedge that's at the money. I sold this 5,4,800, or I bought this 5,4,800 put spread that was at the money for the 79-day period here. And if I go to the curve, all right, so yesterday this was at the money, right? We were closer up here, you know, for this expiration, we were like right at 5,000. I'll admit, I totally got lucky. Like right now I look like a genius because I put it on yesterday, but I just got lucky. But, you know, the market has been really overbought, in my opinion, for a long time. I mean, you look at all these indicators, which I don't even care about those really. It's just, yeah, we've gone on this 20% tear with like almost no pullback. This is the biggest pullback here, right? 2.88%. I mean, we're due or even overdue for like a 5% pullback. So I've been debating this, you know, for weeks, like actually back in here, you know, mid-January, I was debating doing the same thing. And I finally pulled the trigger yesterday and I got lucky. And it's paying off in one day here. But I mean, I guess I need to figure out when I'm going to close this out, because right now it's working great. Yeah, I mean, I'm up 17% in one day. So this week just kind of seems to be setting up. You know, earnings already yesterday were, you know, down, or today were down. And then people were selling off because of Microsoft and AMD and whatever else. And then the Fed thing, and there's a couple more big earnings like Apple. And it just seems like, again, we're just due for a pullback. So anyways, right now it's paying off and I look like a genius, but I guess we'll see, you know, in a week from now or something. I mean, 17% in one day, I'm tempted to just take it. Yeah, I guess I'll let it ride for now. Otherwise, besides that long spiel, you know, all these are doing fine. They're, you know, they've lost money today because these are long positions, right? This 112 has lost almost $10 today, but it still has a greater than 99.5% chance of profit. This hedge we just went over. This hedge is like the Black Swan hedge, it's up $8 today, but it's still down 28 overall. So I highly doubt that will even come into play. This other 112 bear trap is down about $17 on the day. And you know, that still has a 98% pop. That one's only been open 12 days. Oh, one other thing I did open was this 2-to-1 ratio spread, short ratio spread. So I got a 1975 credit, which is just under $100. And that has a 93% pop. And that's only 2 days old. So obviously that's a long position too, because I have 2 shorts and 1 long. So that's down $75 on open. No, I'm looking at the wrong thing. That's down $14 on the open and about $18 today. But again, that's 2 days old. I still have 93% pop. So the futures are looking good. And the SPY, you know, free hedge. I'm not doing anything there unless somehow they start making me money, which, you know, they're up $5 today. And then this 1122 is down $9 today on XSP. And that has an 83% pop. So I'm not going to touch that either. Oh, I did I wanted to get into some oil futures, but I tried the mini or the micro ones or whatever. And man, the spreads were just so wide, and I stupidly put in an order. It got filled, and I immediately realized I had to go like several ticks off the mid price. Yeah, it got filled, but it was, what is this, MCL, I think? So yeah, I was trying to do like a 112 on the 106 day, but like the spread is wide. Like look at this, at the money is like 12, 13 cents wide. And so by the time you put multiple legs on, you're like 50 cents wider. And I was like, oh, you know, this is traded a lot in theory. And so I tried to put it on, but anyways, I lost like $10 putting it on, and then I realized this is dumb. This is illiquid, so I'm just going to close it out and do whatever. So that whole process, I lost $10 putting it on, and I lost $10 taking it off. So whatever. I'm an idiot. So I lost $20 there. So with my hedge that I took way more aggressive hedge, you know, I'm at here $11 on the day for this futures account, which is like kind of the main account I'm trading. And if we look at the overall curve, let's get everything highlighted. I guess that is everything. So as it stands right now, if the market just keeps going up, at expiration, I would lose $20 if I just let everything expire. But obviously, these trades are going to be managed. And that hedge, I guess my plan for that hedge that I put on yesterday is hedge 2 is if this starts, you know, if the market starts to go up, you know, I'll just keep rolling up this, the short put side here. Yeah, just gain more credit. It'll tighten up the spread, but I'll get more credit, and then I can just keep selling puts against it, right? To kind of pay for it as it goes. But at least this one is at the money right now. I mean, right now it's in the money. So I'll just keep selling puts against it. You know, eventually I can cash in on it if I want. And yeah, it'll kind of pay for itself over time. I mean, I might have to pay a little bit. You know, I might be a loser technically, but that's what it costs to trade. That's what it costs to stay in this game. I mean, I've lost a bunch of money, and it's because you can't just trade totally naked like Tasty Trade says you can. You can't, you're not going to be able to manage everything. You'll get a crazy outlier move overnight, or you won't be near your computer or something, and then boom, you just lose $1,000, and you're like, what the hell happened? And there's no way you can get it back. It doesn't matter if you roll it or whatever. So you have to use these hedges, or else eventually you will get burned. And yeah, you're going to have to pay for it. It's like insurance, right? I mean, that's literally why these options were created. So to protect your investments. Anyways, that's where I stand. I don't think I'm putting anything on today. I'm probably just going to keep all these hedges going right now. And, you know, if I take this at the money hedge here, You know, in theory, I'd make $260 to the upside. So assuming I can manage this hedge in any kind of fashion, you know, I'm still going to be making money. You know, I'm not going to take a full loss on this hedge, which would only leave me with $20 up here, right? Guess the plan going forward is I'm just going to kind of sit here and, you know, it seems like I'm a genius for selling that, you know, aggressive or buying that aggressive put spread, but the reality is we're only back here at the 10-day moving average, right? I mean, it's so, I would like it to see it come back here to at least the 50-day. That would be from top to bottom. That would be about, what would that be? I mean, that's only 4.3% sell-off, you know, and then obviously this is going to creep up. So it'd be like a 4% sell-off. That's not even that much, but that's kind of all I'm looking for at this point. I mean, even though people don't like this interest rate stuff, the reality is all the indicators are good and there's no reason the market can't just keep going up. So I'm just going to manage the hedges, let the 112s decay, and yeah, it'd be nice to get a pullback here about 5%, and I cash in the hedges, and then hopefully the market just grinds higher. So let's see if we came all the way down here. I mean, even all the way down to 200 is only 10% correction. So that sweet Bobby Hedge or whatever that he talks up is, you know, it's way down there at like 22%. You know, like I bet if it dropped 10%, you'd still be negative money on that. So I don't get it, but I guess that's why it's a Black Swan hedge, right? It's kind of this once in a 10-year thing. But guess that's it for now. It'd be nice if the market kept selling off, but we'll see. You know, I'll take the profits on the hedges and then sell more puts against it when the IV goes up and everybody thinks the world's ending. So, all right, that's it. Thanks for tuning in. See ya.